Welcome back to Elevate Your Business, a podcast where we discuss proven, transformative approaches to business growth and exit strategies. Join us as we talk to successful entrepreneurs, share new and profitable ideas, and help you grow wiser and wealthier so you can experience limitless success in both life and business. Now, here's your host, Adam Koch, business transition consultant and founder of Elevate and Exit at elevateandexit.com.
Hey, what's going on, everybody? Welcome to the Elevate Your Business podcast, an educational show exclusively for business owners looking for honest, authentic, fiduciary-driven insights and ideas on how to boost the value of their companies and prepare for successful sale and exit. This show is your go-to for authentic, no-nonsense insights on growth, transition strategies, and everything in between. And that's what we're talking about today, is a little bit of that everything in between. We bring you episodes bi-weekly packed with actionable tips and expert interviews so you can navigate the complexities of business ownership and sale with confidence. In fact, I think depending on how today goes, we might even be putting this podcast on our retirement fiduciary podcast, which is for non-business owners as well, because I think today, you'll have to tell me, Andrew, this might actually apply to everybody, not just business owners. But if you do find today's episode helpful, though, don't forget to subscribe on YouTube, Apple Podcasts, and Spotify. Follow us on Instagram, TikTok, Facebook, and X. And be sure to check out elevateandexit.com for even more content. All right, that's all our housekeeping. Let me introduce Andrew, who's been on the show before. Andrew Doup. He's a trailblazer in real estate tax strategies. I'd never met anybody like him before I met him, and still haven't met anybody like him since. He focuses on qualified opportunity zones, also known as QOZs, also known as OZs. Depends on how down you are with the street knowledge and the street credit, I guess, maybe, I don't know. But he's here to enlighten us on maximizing investment potential, all while cutting your tax bill in the process. And I don't know about too many of you that enjoy paying more taxes. So he's the founder of Syndication Counsel, guiding investors through the complexities of economic growth and revitalization. And today we're going to talk specifically we'll do a little bit of background about what QOZs are, OZs, but we're going to talk a lot about state tax credits and how you can take advantage of this very, very little known rare strategy, but before it's gone. But that's I'm teeing you up here before it's gone. So Andrew, thank you for joining me again and hanging out.
Hey, Adam, appreciate you having me back.
Yeah, man.
This is great.
Yeah, it's gonna be fun.
And I appreciate the introduction as well. For those that didn't catch that first episode, just by way of introduction, I'm an attorney here in Columbus, Ohio. I started a law firm called Syndication Counsel, and our clients are entrepreneurs who we advise on how to organize their business plan into a company, and then how to capitalize their company in partnership with private investors who are looking for yield. And so as an extension of that practice, I've been focused a lot of my time on opportunity zones, working with business owners who have exited their companies and now have the option to either pay their tax or defer it until a later date by investing into what are called opportunity zones. So we can dive into that. But I think really what your listeners probably want to know up front is we've got tax returns coming due here in April. And we have this special state income tax credit that's available for anyone who wants to reduce their state income tax liability before then. These state income tax credits are for opportunity zone investments. Basically how it works is you invest into an opportunity zone, you receive a tax credit on the amount that you invest. These are certificated tax credits awarded by the Ohio Department of Development. And they are a dollar for dollar tax credit used to reduce state income tax liability with unused amounts carried forward for up to 5 years. So if you don't have one of these things yet, that's okay, because a lot of these tax credits are being awarded to out-of-state investors who can't use them because they don't have a state income tax liability here in Ohio. So they're looking for people who do to buy them. And so what this means is if you have an Ohio state income tax liability, you want to reduce it by 12.5%, 15%, you should be looking for one of these Ohio state income tax credits, because that's a guaranteed return.
Now, just to kind of throw out some verbal vomit here, because I don't want to completely rehash the last episode we did where we were kind of simmering down to the basics, but can you just, in, I don't know, a 30,000 foot view, talk about what an opportunity zone is, what they're investing in, exactly, types of assets, how it's done?
Yeah, yeah. So, opportunity zones, these are low income census tracts. They exist around the country. They were designated by the Department of Treasury back in 2018, taking nominations by each state governor. So here in Ohio, for example, we've got over 300 census tracts that have been designated as opportunity zones. And the general idea is, rather than pay, if you sell a capital asset, rather than pay your capital gain tax to the federal government, instead, you now have the choice to reinvest it into an opportunity zone in exchange for three tax incentives. What are those tax incentives? From a federal perspective, they are deferral of that tax bill that would otherwise be due and payable. That's tax incentive number one. But what really most clients are excited about is the ability to then exit that opportunity zones investment 100% tax free after the 10th anniversary of their initial investment. So say, Adam, just for example, you sell your business, you've got an outsized capital gain tax bill. Normally you would need to pay it to Uncle Sam. Well, now you have this option where you can defer payment of that tax bill until 2027 if you invest the pre-tax cash amount into an opportunity zone. And you can invest really into anything that's located in an opportunity zone. It can be, real property. It can be an apartment building. It can be an operating company. It's been really fun to see and work with clients in the space who realize that there is this new capital market of pre-tax cash available for capitalizing business plans. So that's the second incentive. The third incentive is also very impactful, and it's on the 10th anniversary of your investment when you're eligible to exit 100% tax free. That exit's also exempt from depreciation recapture. So that's a big benefit, especially for real estate investors. You love taking depreciation deductions during the term of your investment. The catch is you normally have to recapture those deductions when you sell the asset. Well, in the land of opportunity zones, you are exempt from depreciation recapture. So three primary benefits there. I opened up talking about this state income tax benefit. It complements the federal incentives, and it's a 10% state income tax credit. So in addition to these three federal incentives, you get this complementary state income tax credit as well. And that's going to be 10% of the amount that you invest into the asset that you're investing into.
So I know you mentioned the 10-year rule. Can you clarify? Because I think as soon as you say recapture, I think we learn all these lessons as we move along in our careers. And, I remember, I'll never forget the first time I put a vehicle in the business and then I sold it. I'm like, whoa, wait a minute, I got to pay tax when I sell it. How does that work, So it's not like it's not like buying a refrigerator for the office. It's a little bit different. So when it comes to recapture versus not having to pay recapture, how does the 10-year rule fit in? Does it matter from a federal standpoint, state? Just, I guess, clear up some of the mud.
Sure. Yeah. Yeah. So say you invest into an apartment building in an opportunity zone. You can use your pre-tax cash to do that. So in other words, the amount that you would otherwise have to pay to Uncle Sam as capital gain, you can invest into acquiring that apartment building. You would then need to invest at least as much into renovations as the cost to purchase. So you're also not only acquiring the property, you're also substantially improving it. And so, your goal is for ownership of at least 10 years so that you unlock that third benefit, this tax-free exit. During that 10-year term, you're going to take depreciation deductions. And if you were not investing into a non-OZ apartment building, you normally would need to recapture that upon sale. But since you invested pre-tax cash into that apartment building and you substantially improved it, on the 10th anniversary of that purchase, you can then exit. You could sell it 100% tax-free. How it works is you make a tax election to step up your basis to the sale price of that asset. I know we're getting pretty technical here, but essentially that step up in basis happens uh, prior to or after depreciation, prior to depreciation recapture, resulting in the exemption.
So you essentially get the depreciation benefits when you purchase, right?
That's right.
And then you keep it for 10 years minimum. Obviously, you're hoping there's going to be some appreciation in there as well. And normally, the cap gains you would pay, you not only get to take that depreciation, but you don't have to pay the recapture and you get a tax-free sale and step up in basis.
That's right.
Crazy, right? It's like usually in
Amazing.
order to get that kind of treatment, you have to own property and die with it, right? Which means you really don't get any benefit at all. I guess it's your family that gets the benefit. And that's another conversation for another day. But what other, you mentioned an apartment building, what other types of assets are there available?
The only limit is your imagination, Adam. Really. I've seen clients get really creative. The most common case is one where a business owner sells their business and then they decide to launch it again. But this time they capitalize their business plan with the gain they would otherwise have had to pay to Uncle Sam. So they give it another 10-year run. And really all they do is they just put into place what they already know. The only difference here being they've capitalized it with pre-tax capital gain and therefore become eligible for these amazing federal and state income tax incentives.
You got to walk me through this one. I haven't heard of this yet. So sell your business, profit from it. How much time do you have to reinvest into the next business?
Yeah. This is an important point, and it's kind of tricky, but I'll start with the general rule. The general rule is that you have 180 days from the date of sale to defer your capital gain by investing into what's called a qualified opportunity fund. So what's a qualified opportunity fund? It can be something as simple as a 2-member LLC, limited liability company that you organize yourself in partnership with your spouse or a business partner, for example. So there are some special tax rules that apply to how you organize and operate that qualified opportunity fund, but that's the general rule, 180 days to get that done. All right, so once you get that done, you've achieved your initial goal, which was deferral of the tax bill until 2027. You now have up to another 180 days to decide what to do with that deferred gain. So during that period, you're going to identify what your investment asset is. What asset are you actually going to invest into? Is it an apartment building or is it an operating company? In either case, you're going to want to organize ownership of that asset into a subsidiary that's organized for tax treatment as what's called a qualified opportunity zone business. Another set of special tax rules apply to how you organize and operate that subsidiary LLC. But once you achieve those two goals, you have up to 31 months to then actually spend that money as working capital according to your business plan.
Wow.
Again, you could take really any example of what type of asset or operating business you can apply this to, and get a pretty amazing result.
So you could sell your company. You could decide before you're done with the deal that you just don't think you're retired yet. And as long as you put a plan in, a rough plan in place within 180 days, you can set up another LLC, 1-2-member. Does it matter whether it's 1 or 2 members?
It has to be treated as a partnership for tax purposes. Okay. So you need at least 2 partners. That's
2 partners. Okay. So minimum 2 people. Could it be husband and wife?
It can be. And
how about that? And then you can take that and invest it into desks, furniture, conference tables, computers, laptops, chairs, improvements on an office. Can you buy the office building? I imagine, yeah.
That's right.
Improve that office building. Does it have to be? Does the building have to be in an opportunity zone in order for it to qualify as a fund?
So we're talking about two partnerships here. The first one is a qualified opportunity fund. Think of that as your investment partnership. All right. Then the second entity is a qualified opportunity zone business. Think of that as the operating partnership. Okay. So you defer your gain by transferring your funds into a qualified opportunity fund, that investment partnership, which in turn invests into the operating partnership or your operating company. That's going to be the company that conducts the active conduct of a trade or business, acquires assets and makes improvements, pays expenses, generates revenue, and ultimately pays a return to the investment partnership over that 10-year time horizon.
My understanding about when it comes to properties, investment properties and qualified opportunity zones is that you have to purchase them in those zones, in the geographical locations where they've been predetermined to be QOZs. How is a qualified opportunity zone business different? In other words, I imagine you can't just invest in any business anywhere, right? I mean, what are the limitations there?
So it's a place-based incentive. All right. So the general rule is that the investment, the asset that you're investing into is located in a qualified opportunity zone.
Okay.
If you're organizing a qualified opportunity fund, you can do that out of your house. All right. You can invest into a qualified opportunity zone business. Typically that qualified opportunity zone business, that operating partnership is going to be what's located in an opportunity zone. But you don't actually have to acquire an apartment building to do that. You can lease an office in a qualified opportunity zone and still satisfy the standard, so long as you're investing into assets that are located in the qualified opportunity zone. So, you mentioned furnishings, fixtures, and equipment. That all counts.
So the full timeline, 180 days is the first one. I forgot what you said the second stage was. And then there's 31 months, I think you said, right?
Yeah, generally. Yeah, timing is critical here. There's a lot of flexibility with what you can do with the pre-tax cash once you get it where it needs to go. But there's not much flexibility on timing. So I mentioned this general 180-day rule to defer your capital gain by transferring it into the account of a qualified opportunity fund. You get some flexibility on when to begin that 180-day period, depending on whether you sold a capital asset as an individual or through a pass-through entity like an S corp, for example. I've had some clients who have sold operating companies. The first question I ask is, well, have you begun your 180-day deferral period? And the answer is, well, I don't know. Probably, I sold it 180 days, more than 180 days ago. But then the next question is, well, was the company organized as a partnership or as a single member LLC or something else? And if the answer is a partnership or S corp, then you may still be in play. You get to choose when to begin your 180-day period. You could begin it on the date of sale, or you can begin it later on the last day of the partnership's tax year, or even later on the due date for the partnership's tax return. So you get more flexibility if you sell a capital asset through a pass-through entity like a partnership or an S corp. And it's sometimes it can make the difference between whether or not a client has any gain eligible for deferral. So that's one of the first things that we ask during our onboarding process.
Well, so from day one of 180 to the end of the 31 months, which is obviously a tack on at the end there, what's the total duration from beginning? Is it 36 months? I'm just trying to come up with a round number here.
Yeah. It can actually be even beyond that.
Okay, depending on when you start.
Yeah, it can be up to 62 months.
62 months. Because I'm thinking here, obviously, you don't want to take your total, proceeds from the sale of a company and try to figure out how to blow it all in 60 months. Yeah, you didn't pay any tax, but you have no money left either. So I don't think that's necessarily the goal. So let's just say, hypothetically speaking, we extend everything all out as far as we can extend it. We go beyond 60 months, and there's money left at the end of the day that has not been invested, right? And hasn't been spent. How is the tax treated on those dollars at the end of the day? Is it a percentage of it's taxable or all of it's taxable? How's that work?
Yeah. So the idea here is, the government will let you defer your gain so long as you actually reinvest it into qualified opportunity zone business property. So to the extent that you don't do that because you run out of time, according to this timeline or whatever reason, you pay the deferred tax. So there's no penalty. And business plans change. In fact, we saw a lot of that in my practice, during COVID, and during the this rate environment that we've been in. It has slowed some business plans down. It has slowed projects down. In those cases, circumstances may require a change in the plan. The important point being, the worst case scenario here is If you had the intent to make the investment into an opportunity zone, then the worst case scenario is payment of the tax that was already due and payable.
So hypothetically speaking, case study, I sell my company for 10 million. I go through all the hoops. I do everything the way I'm supposed to do it. I invest in a new company in a qualified opportunity zone business. Maybe I buy property, maybe I don't. It doesn't really matter. 60 months goes by. I've invested 9 of the 10 million. I've got 1 million left. Do I owe all the tax? Do I owe some of it? Just to be clear.
No, you don't. The rule is that the qualified opportunity zone business, the operating partnership, it can't hold more than 5% of its assets in what's called non-qualified financial property. And that includes cash. So we would need to figure out what to do to the extent the company has cash in excess of 5% of its total assets. And there are many ways that you could manage that liability risk. One would be to just return it to the qualified opportunity fund, that investment partnership, which would then just place it into a different asset, or pay the deferred tax on that amount.
Take the net gain.
Yeah, take the gain. And you actually you made a good comparison. That's to 1031 exchanges. Drop till you swap when it comes to deferring gains on real estate. The programs are similar, but also different, I think, in important ways. And one of the other important differences is that you don't have to defer your 100% of your gain. You can pocket however much you want and defer the rest, however much you want to parlay back into your next venture. So you get much more flexibility with opportunity zones in that respect.
Yeah, that makes sense. Back to the state credits. I know we've talked offline months ago. You and I were sitting down having lunch, and you were talking about how the state tax credits, it's a dollar for dollar credit, first of all, which I'd like for you to explain that in layman's terms so people understand what it means. And then the carry forward, just kind of elaborate a little bit more on that, the 5-year carry forward. And then the fact that these things are offered at a discount as well, which I think is an important piece of the puzzle. Can you talk to those 3 things?
Yeah. So we spent a lot of time talking about the federal opportunity zone incentives. So going back to the state opportunity zone incentive, this is a state income tax credit. And as I mentioned before, there are a number of these that have been awarded to out-of-state investors who can't use them. So they want to sell them to someone who can. And the reason why, if you're a taxpayer, you want to buy these is because you can buy them at a discount, and they are a dollar for dollar reduction to the amount that you would otherwise owe to the state of Ohio on your individual income tax return. So any amount you can't use in your current year, you can carry forward for up to 5 years. And so, if you're buying tax credits at a 12.5% discount to face value, you can claim that dollar for dollar on your individual state income tax return. So it's a pretty good return on an investment, if you want to look at it that way. And it's pretty immediate as well. The only hang up here is that they're limited in number and they're available on a first come, first served basis. So I reach out to CPAs and other advisors whenever these things become available. Because if you have a client, if you're an advisor and you have a client who wants to reduce their state income tax liability, then reach out, get your hands on one of these. You can get a 12.5% discount on that tax bill. We've been doing these since the inception of the program. So since 2020, we've done over 180 transactions. We've delivered over $8 million in tax savings to the folks that participate. And a big part of the reason for our success is because of our process. Over the years, we've established a vetted network of buyers and sellers and advisors in this space. So we can vet certificate authenticity. We provide buyer and seller confidentiality. But what makes us really build confidence in our process is when the buyer funds the purchase price, we hold that purchase price in escrow until the Department of Taxation validates the transfer. So that's what gives buyers and sellers confidence in this marketplace for Ohio state income tax credits.
That's awesome. And you took my next question away because I was just curious if you even knew what the total tax savings has been just out of your office alone. So that's amazing. And $8 million in tax savings. And I don't think if you don't know already, if you're listening, watching, if you don't know already, avoiding tax, and by the way, I said avoiding, not evading. There's a difference. But avoiding tax on estate tax is extremely difficult. It's very hard to do. So this is a huge opportunity, no pun intended, that again, super rare, super not so well known. I wasn't the most eloquent there, but I have one more question. There is all this, I don't know, talking heads, right? There's always fear out there. I feel like that's the way of the news, social media these days. Everybody's out there trying to scare the crap out of everyone. And what I've read or heard is that there's this clock ticking toward the QOZ program's, 2026 sunset. What's your gut feeling about this? Is there just no merit in any of the fear mongering here? Do you see an extension on the horizon, or maybe an evolution? Maybe things change. What do you think is going to happen?
Yeah, you're correct to point out that this legislation is scheduled to sunset. The benefit of deferring a capital gain tax bill will sunset year end 2026, and that's set in statute. So it would take an act of Congress to change it. What's funny, though, Adam, is a couple of weeks ago, I was in DC at a National Opportunity Zones conference on election night.
Oh God,
And
I'm sorry.
well, I got together with some colleagues in the industry and we had some dinner and there was a TV in the dining room we had up. And, generally the mood was, pretty grim. Some folks talking about, how am I going to, what am I going to do after Opportunity Zone sunset? And it was interesting to just witness, in real time, the mood in the room change as the election results came in. Because with the Republican sweep, there is a lot of optimism now about opportunity zones not only being extended, but being expanded. This National Opportunity Zones conference, I attended the next day. There were some representatives from the next administration and the next Congress in attendance, basically there to tell the industry that this was, one of the primary campaign platforms that was championed, and it's not going away. So, 2025 it is widely regarded in the tax community as the Super Bowl of tax, because that's when other provisions of the Tax Cuts and Jobs Act are set to sunset or scheduled to sunset. But among all the provisions that are scheduled to sunset, there's a lot of enthusiasm for opportunity zones to be extended and to be expanded. And I think it's important for folks to know the reason why is because opportunity zones are bipartisan legislation. They actually were proposed during the Obama administration. They happened to be enacted during the Trump administration with sponsors coming together from both sides of the aisle. And you take a step back from the incentives and take a look at the larger public policy, it's easy to see why. Because you're giving investors the opportunity to, rather than invest into Uncle Sam, instead invest into your local community with taxes that you would otherwise have to pay to the federal government. So it's had a huge impact since 2018 in the state of Ohio. That impact we can actually measure because of the state income tax credit. The state collects data about all the investments that are being made in exchange for the award of these tax credits. And I made a public records request from the Department of Development recently. And I've analyzed the results. And what we see is that private investors have placed $1.8 billion into Ohio opportunity zones. And, the dollar amount on a national level is around $100 billion. So this is a huge economy. It's a big marketplace, and it's not going to go away. And if anything, it's going to improve.
I'm glad you said all that because I was actually going to say, well, I've got one more question for you, actually, because as soon as you talked about Washington, and obviously I think that politics is an extremely sensitive topic right now, as you and I were talking about offline. But I just wanted to talk about all the good that this is doing in communities. So I'm glad you said all that because, these opportunity zones, the investment of private sector dollars back into the community, are not only revitalizing neighborhoods that were once dead, turning areas that were just dark gray parking lots into something bright and shiny, but they're creating jobs too. Jobs that just literally didn't previously exist. It's like the old saying that, sometimes people feel like that when you do certain things when it comes to investment and money, that you're taking money away from something and giving it to something else. So you're changing where the money goes in the pie. When in reality, what this is doing is it's making the pie bigger. The pie is just getting bigger, right? So
yeah,
it's amazing.
Yeah, that's right. That's right. I think on my last appearance on your podcast, I called this the greatest the greatest tax incentive in U.S. history. But taking a close look at some of the changes that are being proposed for this program to make it more transparent, also to graduate some of those low-income census tracts out of the program and bring new distressed communities in, is going to create, I think, a lot of positive change as well for this incentive. And if those changes are made, I think that we'll be calling this the greatest income tax incentive of our American future.
We'll say, or a lifetime at the bare minimum.
That's right.
Yeah. Well, that's our time today. If you'd like to get a hold of Andrew, you can message him on LinkedIn, connect with him there. Of course, you can head over to syndicationcounsel.com and find him there. You're also going to find all of the links, contact information in the show notes below. But as I always say, there are thousands and thousands of podcasts out there, and you chose to listen to ours today and watch as the weather changed in my office, and now you can't even see me with all this light in my face. But thank you so much for hanging out with us, and we'll see you next time.
We hope you enjoyed today's episode. To complete our free business valuation quiz or to set up an introduction call, just head over to elevateandexit.com. This podcast is for informational purposes only and should not be considered legal, financial, tax, or as a basis for investment decisions. Always consult a professional business transition planning consultant or a certified exit planning advisor before implementing any of the ideas shared in this episode.